Hey, Mike, you may want to unmute. I don't know if we can hear you just yet.
Yep, I'm on.
Okay, great. You're ready to go.
Okay, appreciate that, Justin. Thank you for everybody joining us today. I really appreciate that. We have some very positive things happening at ING these days that, frankly, if you're paying attention to the fixed and index annuity world, there doesn't seem to be a lot of positive announcements happening right now. So what I wanted to focus on today was two new crediting methods that we've recently launched that will allow you to better diversify your clients' safe money needs. And I think by the end of this presentation, you'll see that the two of them complement each other very nicely. If you came here today looking for some detailed product nuts and bolts, this isn't the presentation for that. We're going to talk at a very high level about some of our top selling products, but we're not going to get into the details on them very much. We want to stick strictly to the crediting methods, how they work, and really how they're sales concepts in themselves. So that being said, I wanted to get into before we get into those, let me set the table with maybe a few obvious things. As all of you know, you have your clients have different goals, needs, financial dreams that you're out there every day trying to help them meet. Obviously, there's no one-size-fits-all solution to that. I'm certain that everybody on the line has clients that are concerned about losing purchasing power in retirement, fear of locking into a low-rate product today in the historically low environment that we're in, and looking to take advantage of a rising rate environment that is sure to happen. If there's one thing we know about rates is that they rise and fall, and they will eventually start rising. I do want to go back to that fear of locking into a low-rate product real fast. That's a particularly frustrating aspect to everybody in the industry. You know, with the average 5-year CD out there nationwide paying just over 1%, the average 1-year CD paying around 0.5%, the average money market account nationwide literally paying almost 0%. Unfortunately, those are the options and those are the rates that most of our clients are forced to take, for the money that they want to be safe money. Now, on this next slide, here's the options that we know are out there. You don't need to be an experienced investor to know this either. The financial product spectrum ranges from high risk, high return, the stocks, bonds, mutual funds, etc., all the way down to the low risk, low return that include those CDs, money markets, and savings accounts in a lot of cases. Our clients, believe it or not, are more liquid than ever before. There's actually, in the fourth quarter of 2012, for one of the first times ever, savings accounts deposits were up and CD deposits were down, which tells us that clients want the liquidity and the safety of a savings account rather than the low rate. So our clients know that. One thing they don't know, and what we're here today to talk about, is somewhere in the middle there is a solution for them in the form of fixed index annuities that will provide them the safety and the principal protection that they're already seeking in a bank, and then also provide them a little bit more upside potential than the current fixed rate environment is able to provide. Just a brief definition of an index annuity for those of you on the phone that might not be familiar with them. Not going to spend a whole lot of time on this. It's an insurance product by definition that's designed to provide guarantees, minimum guarantees, income guarantees, interest guarantees, death benefit guarantees. At the end of the day, it's an insurance product, and it is a fixed annuity. The only difference between an index annuity and the traditional fixed annuities, where we're declaring X% for the next X number of years, is that we're using some type of external index or indices as a measuring stick of sorts as to how much interest to credit. We have 3 different index annuities to choose from. And again, I'm not going to spend much time on this, but for those of you that are already familiar with our portfolio of products, you already know that we have one of the most client-friendly, straightforward portfolios out there. We basically have one product with 3 different versions. So the beauty of doing business with us is that you only need to learn one product, and then from there determine which one might better suit your client's needs. For those of you on the line that aren't familiar with us, I do want you to take a lot of comfort in the fact that we truly do have one of the most client-friendly portfolios out there. The Secure 5, it's our 5-year index annuity, and the unique thing about that is that it comes with an optional return of premium feature to it. That provides a lot of peace of mind for those clients that want to make sure that they can keep their money within arm's length, keep it safe within arm's length, and for you to be able to look them in the eye and assure them that regardless of when they surrender, if they have to get out of that early, they're guaranteed to get at least their premiums paid back. The Secure 7, it's a 7-year product. Instead of having the return of premium feature on it, it just happens to be blessed with some of the best rates and caps and multipliers in the industry. So it makes for a great growth and accumulation type vehicle. The Secure Opportunities Plus, it's a 10-year product, exact same as the other two, except that it comes, the unique feature of that is that it has a built-in premium bonus to it. So if you have clients, for instance, that are looking to shore up some guaranteed income stream later on down the road that they might want to fill in some gaps, you know, between pensions and Social Security, etc., that might be a great product for that. But again, it's the same product, just 3 different variations of it. So we've intentionally made it very easy for you to position one or the other. They all have the same liquidity features, the same crediting methods, nursing home terminal illness waiver, etc. And it's these crediting methods that make an index annuity an index annuity. We have the fixed rate strategy, and then several different index link strategies to choose from that are, you know, going to be the same options available out there with most of our carriers. Frankly, across the industry, when you take a look at all the products, there's literally dozens, probably hundreds of different combinations, crediting methods, indices, etc. to choose from. We want to focus on 2 of them today, and it's the performance trigger and the interest rate benchmark strategy. And by the way, we do allow you to allocate accordingly and split it up between the various crediting methods, and then allow you to do that every year on the anniversary for every product. And then also, I want you to keep in mind, if any questions come to mind as we're going over here, go ahead and type them in to the box there, and then at the end, Justin and I can get those addressed. The newest one that we want to talk about is the ING Performance Trigger that's available on all 3 of the products. The Performance Trigger, and this is by far, hands down, the easiest crediting method in the industry to explain and understand. It's a point-to-point crediting method. All of our crediting methods are point-to-point, which means that we're crediting interest every year on the anniversary date. The trigger rate is going to be credited if the S&P 500, which is the index that we link it to, experiences 0% or more growth. In that case, if there's 0 or any positive growth whatsoever, that declared trigger rate is automatically what we credit to the account. This is just another visual of that. 0% or greater, even if it's just a fraction of a percent increase, it will automatically trigger that rate that we've set. This is an example of what it looks like. Going back to 2011, the beginning S&P 500 number was 1307 and change. And then on the anniversary date, February 2012, it grew to 1324. If you do the math on that, that's a positive increase of 1.26%. Because the declared trigger rate was 3.5, boom, we automatically credited 3.5 to the account. Doesn't matter if it was 1.6, 1.26, 0.26, 5.26, whatever that positive growth is, we automatically declare that trigger rate. So it takes a lot of the guesswork out for your clients as you're sitting down with them trying to determine what type of market it's going to be, where am I going to get the most bang for our buck. Frankly, if you're familiar with index annuities, you know that we're in a otherwise pretty low annual cap environment right now. So to have the performance trigger on there is going to be a nice solution to that. What I wanted to show here is a hypothetical example over a 5-year period. As you can see, during a slow increasing market, which is what we're going through here starting in year 2, the trigger strategy is going to provide upside potential by protecting the accumulation value, because again, that's the power of annual reset. So in this example that we're looking at here, in that first year, we saw a decrease of over 11%. And then as we move forward over the next few years during a slow increasing market, the value actually went up. So in this hypothetical, the client actually received, because of the performance trigger, actually received over the course of time a little over 10% interest credit to the account, even though the S&P 500 over that time period was actually down. And that's the power of the performance trigger, and more importantly, really, that's the power of doing it on an annual basis, locking those gains in every single year. So the current environment that we're in, it shouldn't be any secret to anybody on the line that we are in a historically low rate environment. I've put up a slide here of the 10-year Treasury over the last 30 years, and we can see that. And I talk specifically about the 10-year Treasury because it's historically been one of the better barometers as to what's happening in the index annuity rate and cap world. So, this is going through 2011. Most of 2012, it's been well below 2%. And in fact, most of the time, at least over the last couple of months, it's been right around 1.5%. So that is creating a frustrating environment for us. And it's definitely impacting the fixed rates out there, the caps out there, the mortgage rates, the car loans. So that there might be there's some good aspects of having a low rate environment in that regard, but for our clients who are hitting retirement and at the point where they need to start de-risking themselves and keeping up with inflation once it kicks in, it's incredibly frustrating. The light at the end of the tunnel in this environment is that we can sit here this morning honestly and say with 100% certainty that rates will go up. I'm not exactly sure when that's going to happen. Most people think that it's going to be sooner than later, but we know that it's going to go up. And in fact, there was a Rasmussen report survey earlier in the year, and who knows, some of your existing clients or prospects could have been part of that. Most of the general consuming population, just over 50% of the general consuming population, believe that interest rates will be higher a year from now than they are today. And when that happens, that's why we've created the interest rate benchmark strategy. This is the second crediting method that I wanted to talk about today. And I said that the performance trigger was by far the easiest crediting method in the industry to explain and understand. This is going to be the second easiest crediting method in the industry to explain and understand. It's specifically designed to perform in a rising rate environment. And the way it works, and I'm going to read this, it bases interest credit on an increase, if any, in the LIBOR rate multiplied by the multiplier up to a cap floored at 0. That sounds like a lot, but there's two questions that are derived from that. Number one, what's the 3-month LIBOR? And number two, what's the participation multiplier? The LIBOR is an acronym. It stands for London Interbank Offered Rate. And basically what it is, it's the rate that banks use internationally when they're lending money back and forth to each other. It's historically been a widely used benchmark in the short-term lending world. One of the things we liked about it is that even though it's technically subject to change daily, it's historically risen and fallen fairly steadily, not unlike most rates out there. And if you're familiar with rates at all, you know that rates are designed to go up and down, as opposed to the market, like the S&P 500, that's designed to hopefully increase over time. Rates don't do that. They go up, they go down. So the 3-month LIBOR rate, even though you may or may not be familiar with it, if you're not familiar with it, it's still impacting your life. It's taken into consideration on everything from mortgage rates, student loans. A lot of credit card loans are tied to this. If you have any type of banking or mortgage background, you're likely to be familiar with it. If you've done any premium financing in your life business in the past, LIBOR was a big part of that. So even though our clients may not have heard of this, it doesn't change the fact that it's impacting their lives almost every single day whenever they walk into a bank for money. I put up here the history of that LIBOR rate, just going back to 1989, just to show you historically how rates go up and down. And you don't see this on the screen, but I want you to take my word for this. Over this 22-year time frame, the average LIBOR rate was right about 4.15%. Look at where it's at today through January of 2012. And as of right now today, it's at about 0.43%. So the last 20 years, 4.17%. Today, 0.43%. So to have the ability to take advantage of this rate as it rises is what we're so excited about. We know rates are going to rise, and it's got a long ways to go just to get to its 20-year average. What I've done in this slide, this is the exact same slide, but I've kind of chopped up the last 3 recovery periods in the LIBOR rate. Just to kind of further illustrate the advantage that we have to take advantage of a rising rate and the power of doing that on an annual basis. From July of 92 to December 94, that's a 2.5 year recovery period. September 98 to May of 2000, another 2-year recovery. 03 to 06, that's a 3-year recovery period where our clients would have been able to take advantage of that as the rate is rising, without that fear of locking in at X% for the next X number of years. And if anybody's out there selling like 5-year MIGA rates right now, you know what I'm talking about. The best 5-year rate out there, might be, and I'm probably being generous here, might be 2.5%. 2.5% on a 5-year product is a great rate today. In 2 or 3 years, if rates rise like most of us think they are, is 2.5% locked in for another couple years? Is that going to be a good rate? No, it's not, especially if there's 5-year MIGA rates out there that are, at 5 or 6 or 7%. So that fear of locking into a low-rate product right now is frustrating. We are giving you the ability to take advantage of it as it's rising without locking in. So the second factor, or the second question of the LIBOR, of the interest rate benchmark strategy, is what's the participation multiplier? What it is the factor that we apply to the LIBOR growth every single year on the anniversary date. It is also declared annually, good for 1 year, and it's capped at 10%. So we're talking about an annually reset index annuity that has a 10% cap right now. And this is what it looks like. It's very simple to explain and understand, for the simple fact that the LIBOR is already expressed in a percentage. You take the ending LIBOR rate minus the beginning LIBOR rate, determine how much that grew, times the multiplier, and that's what we credit. This is what it looks like. This is a historical example going back to March of 1994, when the beginning LIBOR rate was 3.94%. Remember, today it's at about 0.43%. So a year later, that LIBOR rate grew to 6.27. We do the math, it grew 2.33%. We had a declared multiplier of 4, so we credited 2.33% times 4, we credited 9.31%. It is capped at 10%. So what we've done in this scenario, we've allowed our client to take advantage of that rate as it rises without having to lock in at a rate today. Again, the good thing about interest rates is there's, historically speaking, there's probably a pretty good chance that it's going to rise the next year as well, especially if we caught this, at the bottom on its way up. So very powerful strategy to have in this industry right now. And for what it's worth, this is an absolutely industry-unique crediting method that you won't find anyplace else. I've attached our current rate sheet here. I've highlighted the interest rate benchmark strategy and the performance trigger. You'll see on here that the rates and caps and multipliers are different depending on the product and depending on the premium. So as you can see here, on the bonus product, you have a multiplier of 4, a performance trigger of 2.5. The 7-year product, multiplier of 5.5, the performance trigger of 3, and then the 5-year with both the return of premium and the non-return of premium options on there. A couple of the main objections we get on this interest rate benchmark strategy is, number one, why would I go into this crediting method when the feds are on TV all the time saying they're keeping rates flat for the next couple of years? And the way to overcome that, or not really overcome it, the answer to it is that the feds do not control the LIBOR rate. The feds control the Fed funds rate, and then that determines the prime rate. They do not control the LIBOR rate. There's a group of about 18 banks internationally, 3 of which are U.S.-based, that meet to set that rate. The second objection we get is, I understand how it works, but I don't necessarily see it rising enough to be worth my client's while. Well, take a look at the multiplier on the Secure 7 at 5.5. You only need to see a fraction of a % increase, times 5.5 to outperform, every other, 1-year fixed rate vehicle out there. I mean, just a quarter of a % increase, which we've seen in the LIBOR rate over the last year. It has increased about 0.25%. Just a fraction of a % increase, you'll still get in that, with a 5.5 multiplier, well over 1% credited. You're not getting 1% on a 1-year basis, really hardly any place else. So we call this an opportunistic strategy, the interest rate benchmark strategy. Opportunistic, that it's specifically designed to perform in the environment that we're in right now. One thing we know about this strategy is that because rates do go up and down, once rates get high in a few years, hopefully, it'll start leveling off eventually and then start dropping again. We know that this crediting method isn't going to perform in a decreasing rate environment. And that's why we've added this as an additional crediting method as part of the overall diversification for your clients. Get into it now while you think rates are going to start rising. Stay in it until they start leveling off and declining, and then reallocate into one of the other strategies that we have available to you. So it's all part of a broader diversification strategy to help your clients beat that indecision that they have right now in the environment. So as we start wrapping things up here, I want to talk about who's going to benefit from this, especially this particular strategy, because it is industry unique. There's broad appeal to this. If you have any clients and prospects that fear losing purchasing power in retirement, think inflation is coming, can't afford to risk their nest egg at this point, this is a great strategy for them. If you have clients that are frustrated with the low rates, that have money sitting on the sidelines in those CDs that are in money market accounts that are earning virtually zero, this is an ideal solution for them. I would venture to say there's a lot of people on the call today that through doing other business, whether it's life or long-term care or other annuity business, through your fact finding, you've probably already identified the clients that have money sitting in CDs, earning virtually zero. And I would venture to say that a few of you that have done that have been flat out told by these clients, I have $100,000 or X amount in this CD earning virtually zero. Call me when rates are high, and we'll do something with it. That's great that they're keeping you in mind for that, but waiting for rates to get high, you might be too late. That client has missed out on the opportunity to take advantage of rates as they're rising. Rates don't go from low to high overnight. They do it over the course, historically speaking, of 2 to 3 to 4 years. Any of your clients that are just seeking safety and looking for more diversification for their safe money needs, this is an ideal strategy solution for them. Available on all of the products, can be used combined with that performance trigger strategy. If there's one thing that you can get from ING with doing business with us, you know that we have, or at least I hope you know that we now have one of the most client-friendly portfolios in the industry. We don't want to make it hard for you to explain products for your clients. Also, with the ING brand name backing that up, You don't have to sell a company either. Statistically, your clients are already familiar with ING, and they know that we have something to do with the financial services industry. And there's a lot of trust in that brand name as well. So what we want to do from a marketing standpoint that you're going to find with us that you're not going to find with any of our competitors is that we're able to allow you to put more emphasis on the index annuity as a concept. We want to make it be easier for you to talk about index annuities with your clients, where they fit, where they don't fit in some cases, what they are and what they aren't. You know, we feel that if we can get you talking with your clients about the concept of index annuities, you're much better off doing that than just promoting one product over another product. So if there's anything you get from ING today, get a hold of the folks at Financial Brokerage after the fact, and at the very least, get your hands on some of the client-approved marketing pieces that we have. So just to summarize the two crediting methods that we have that are going to give your clients choices that they're not finding anyplace else as their expectations change, because again, this is all part of a broader diversification to help your clients with their indecision in this crazy environment. The trigger strategy will perform well in a market with slow and steady growth. It's also the easiest in the industry to explain and understand. The interest rate benchmark strategy is a great option that's going to allow your clients to benefit from a rising rate environment without that fear of locking in at X% for the X number of years and use as a potential hedge against inflation. So we're very excited about these. I hope that both of these strategies are something that you think you can use for your clients. If you're already familiar with ING, you know, the trigger strategy just came out within the last week or so, so this might be the first time you've ever seen anything on that. If you haven't been familiar with ING, hopefully this is a great way to get you familiar with ING. And the most important slide of the presentation is up there right now. This is Financial Brokerage contact information. If there is anything that you need after the fact on anything that we've discussed on the two crediting methods, anything we haven't discussed. For instance, if you're doing any income riders for your clients. We have one of the most competitive income riders in the industry that has a few features that make it completely industry unique. If that's part of your overall business, get a hold of Financial Brokerage and make sure you're getting what you need to do business with ING. So with that, Justin, I'll go ahead and turn it over to you. Are there any questions that have come in?
Yeah, I did have a couple, and I think this probably takes it back to pretty early in the webinar. The question was, do all three of these have the return of premium feature?
That's a great question. The Secure 5 is the only product that has the return of premium feature. As you know, as I said, we basically have one product with three different versions. You know, with a feature that makes them industry unique, or unique from the other one. The Secure 5 comes with that return of premium. The Secure 7 is kind of our flagship product and always has been, and it just happens to be blessed with some of the best rates out there at any given time. The Secure Opportunities Plus has the built-in bonus. Those are the features that make it industry unique, or unique from one another, I should say. But that's a good question that I probably didn't do a good enough job clarifying to begin with.
Okay, no problem at all. The other one was questions about how people are responding to the current issues you see in the press about LIBOR.
That's a great question also that I'm not surprised it didn't come up. It's a fair thing to bring up. For those of you that aren't familiar with it, there has been a little bit of a scandal in the LIBOR making the news in recent weeks that goes back to, it actually is kind of old news. It goes back to 2007, 2008, where there were some banks attempting to manipulate the rate for their own benefit. It isn't really clear whether they tried to drive it down or drive it up. It's just that they were trying to manipulate it for their own benefit. When we launched this strategy, last fall of 2011, and this issue did come up. We vetted it out. We actually delayed the launch of it. We brought in some outside counsel to take a look at it. one of the big things we wanted to determine was, is the LIBOR as we know it going away? And it was determined that the LIBOR rate as we know it is not going away. Now, the scrutiny on it is probably going to, create more regulation, more scrutiny, more eyes on the process. But we're confident that the LIBOR rate is not going away. And at the end of the day, it's important to keep in mind for the clients that might be concerned about this, or you on the phone that might be as well. We're not investing in the LIBOR. We're not investing in the banks that are part of the process. We're just simply using whatever rate it is they're setting as a benchmark, as a barometer as to how much interest to credit. And the fact of the matter is that it's still right around a historic all-time low. In fact, last year at this time, it wasn't an all-time low. It was at about 0.25% a year ago. So it has increased slightly since then. And, who knows? Increased scrutiny and regulation on it might drive it up. And for the people that are in this strategy, that's a good thing. But it's a fair question to bring up, and we're not, overly concerned about it, to be honest, because other than just using the number that's spit out, we have nothing to do with it. I hope that answers the question. I guess I don't want to overkill the issue, but an analogy that I might use would be, in the S&P 500. That we have a lot of index annuities are linked to the S&P 500. There's companies. Those 500 companies that make that up, they're changing all the time. And if one of them were to get, caught cooking their books, doing something shady, they're likely, they're going to get kicked out of the S&P 500. Somebody else is going to come in. It's probably going to cause a temporary, spike or drop in it, but it's not likely to make the S&P 500 go away. And I think, with the LIBOR, that's a fair analogy to use, especially in the fact that we're not investing in the LIBOR or those banks. So I hope that answers the question. If it didn't, get a hold of financial brokerage, and we can conference in and talk about those details. If there is anybody else on the line that has big concerns about that, let us know.
Okay, great. No, I think that's a good explanation. I'm going to have some product questions here for you, if you don't mind.
Sure.
I'm seeing what's the minimum guaranteed interest rate on fixed interest account?
Okay. The minimum guarantee interest, the minimum guarantees on the products are 1 on 87.5% of the premium, and that's something that you've probably seen a lot of in the industry over the last couple of years, or companies are bringing down the minimum guarantees. On something like the 5 and the 7-year product, basically what that means is your worst case scenario after 5 or 7 years is that you're getting your premiums back. Geez, I remember, I've been around for a while. I remember several years ago when we moved the minimum guarantees from 3 on 100 down in some cases to like 1.5 on 100. And we thought that was going to be the worst thing in the world. Well, guess what? From a historical standpoint, the minimum guarantees hardly ever come into play anyway. Definitely haven't on the 10-year products. We might be in the middle of a 5-year period where it's been, coming into play on a 5-year product, but I'm not certain about that. In order for us to provide as much upside value for our clients, there are some concessions that have had to be made over the last couple of years, and the reduction of the minimum guarantee and still having the ability to provide the principal protection is one of the things that companies have had to do.
And a bit of a follow-up is, what is the minimum guaranteed interest rate for performance trigger crediting option?
It's technically, contractually, 0, and I know people hate hearing that answer. It's more actuarial, honestly, than anything else. The fact is, the more guarantees a company puts into a product, the more we have to put on reserve to back up that guarantee. And Justin, for the record, if that question wasn't asked, I'd probably get into it anyway. The more guarantees in a contract, the more the more the company has to hold back on reserve to back up whatever the guarantee is that they've set. And all of the companies are impacted by this. We're in an environment right now where pricing is tough. That's why everybody on the phone, if they've been paying attention, they've seen just about everybody out there in the industry make some type of concession, whether it be on their bonus, on their income rider roll-ups, on their commissions, on their rates, on their minimum guarantees, or on all of the above. It's a tough pricing environment out there. Now that being said, the performance trigger, even though it's technically 0, we don't have a track record of doing that. I mean, we're ING, we have the A rating, and we want to keep that. It's more important than ever before for companies to keep their ratings. And if there's a history of pulling the rug out from under people on renewals, your ratings are probably going to be taking a hit if you're even staying in business long enough for the rating agencies to catch on to that. So the thing, how I counter that for the people that don't like the fact that it's 0, and that holds true for the caps, the annual caps, the monthly caps as well, that we also have. We're one of the only companies in the industry that actually maintains and publishes our entire renewal rate history. These 3 products were launched back in the fall of 2005. So we've had them for a long time. That's a long time in the world of index annuities to have the same products on the books. We've maintained and published our entire renewal rate history on every bucket of money that's come in the door since then. And it is client approved. It's a lot of information. I don't necessarily, and wouldn't encourage you to, throw it in front of your clients unless they've specifically asked about it. But we give it to you. We have nothing to hide. And if you look at our renewal rate history, you'll see that we do not have a history of pulling the rug out from under people. And knowing that on all these annually reset products, knowing that the companies have reserved the right to increase, decrease, or hold those rates at renewal, I would ask you, do you want to do business with a company that will show you how they've treated their clients at renewal, or do you want to do business with a company that won't? So that's a long way to answer the question, but that's my answer, Justin.
No, that's great. That's well said. That's well said. So, well, I think that is all that I see trickled in on questions. So I definitely want to thank you again, Mike, for that today. I want to thank ING for their strong partnership with us over the years. And on behalf of Financial Brokerage, I want to thank, again, all the webinar participants. If you have any questions concerning this webinar, certainly feel free to give us a call here. The number is posted, 1-800-397-9999. Our guys in the annuity department would be more than happy to discuss anything you have, Jim, David, and Matt. And so everyone have a great and productive day. Mike, thank you once again.
Yes, thank you, Justin. Thanks again, everybody, for attending. Take care.
All right, thank you. Bye-bye.